Hello, everybody. Welcome to our Facebook Live with our special guest, Deline Jacovides. So, Deline is here to talk to us about super recontribution strategies and what I think is a secret weapon for estate planning. So, welcome, Deline.
Hi, Tara. Thanks for having me. I'm super excited about this.
Well, I'm delighted to have you. I mean, we have been friends for years now, and I can't believe I haven't had you on here before. So I'm really grateful that you are prioritizing this and sharing your knowledge on what I think is going to be a really valuable topic for everybody. Now, before we dive into that, Deline, do you want to tell everybody a little bit about yourself?
Yes. So you're right. We've known each other for a few years now. We've had mutual clients from a financial planning and an estate planning perspective. So it's been pretty cool. So I am a financial planner. I have been an advisor for about 9 years now. And I have specialised with the more retirement planning type advice. So people in the lead up to retirement, at retirement and in retirement. And so because superannuation is such a big part of most people's retirement plan, I do see myself as a bit of a superannuation specialist. And I guess in regards to superannuation, then we start talking about estate planning and because of those older clients. And I have worked for a couple of different types of firms before. So I have worked for private boutique financial planning firms who mainly specialised in self-managed super funds. And then I've also worked for some industry super funds as well and advised the members from those funds and their spouses. And the point I want to make firstly is that it doesn't matter what type of superannuation product we're talking about here. We can generally look at this recontribution strategy regardless of whether it's a self-managed super fund, a retail or an industry fund. So in terms of the implementation of the strategy, they might differ slightly, but the broad strategy can be done regardless. So thought I'd point that out to start with.
Oh, thank you so much.
And I thought I would just explain the picture on the front page here as well. So when I talk about superannuation with clients, I always talk about it like it's a bag of marbles. And I use red marbles and green marbles to help clients visualize the taxable and tax-free component of their super, which I'll go into detail in a moment. But clients love that because it can be a bit confusing, concessional, non-concessional, taxable, tax-free. So having the colours helps them remember. And I have clients coming back year after year saying, oh, is this the account with the red marbles or the green marbles? And they're able to remember it quite easily. I couldn't actually find a picture with the red and green marbles, so that's why there's red and green M&Ms. It's the same concept, so I just thought I would explain that.
I love it. So before we dive into it, I just want to let everybody know. So Deline has kindly said that she will take questions. So if you do have questions, please feel free to put them in the comments box and we'll keep an eye on those and then find an appropriate juncture to address those. And I really kind of just wanted to give a bit of context about why we chose this topic. So for the lawyers out there, we're not trying to upskill you to be giving advice on this strategy today. Really, the whole point of it is for us to have enough information to identify the issue and realize when we should suggest to our clients that they need to talk to their financial planner or refer them on to a financial planner if they're not talking to someone. So this isn't for the lawyers to suddenly, start giving advice because it's not something that we can give advice on. And perhaps the same for accountants if you don't have your AFSL. So I really just wanted to sort of give that context about some of the detail. If you're there going, oh my goodness, there's a lot of rules here. Unless you're a financial advisor, you probably don't need to know like the really detailed ins and outs of the rules. We just need to know enough about when we can add value and bring in a financial advisor. So
Yeah,
that's all I'll
correct.
say for now. Over to you, Deline.
Yeah, that was actually going to be one of my points I made early on. I was going to make early on that it might seem simple on the surface, but as I go through today's information, you'll probably see that there's a lot of it can be quite complex. And what I've tried to do today is make it very simple, the information, and high level. It could be very easy for me to go down different tangents on the different aspects to this strategy. But I'm trying to keep it simple, and I've tried to just cover off the most common scenario, I guess, or scenarios, and not get bogged down too much into the detail.
So if you're watching this and you're a financial advisor, go easy on Deline.
Yeah.
Don't start quoting legislation at her.
Yeah. And yeah, that leads on to this general advice. This is general advice. It's not specific to any individual, so anyone's individual circumstances, because everybody's family structure will be different. Everyone's tax situation is different. Everyone's goals are different. So yeah, it's not to be relied upon in any way. This is just general information, as you mentioned, Tara, for people to be able to identify when there might be some value to be added with a financial planner. So I just wanted to broadly touch on what is a recontribution strategy and broadly how it works. And then I'm going to go into the detail for the different components, but just so you know what I'm talking about to start with. So a recontribution strategy seeks to increase a member's tax-free component in their super. And the way the strategy happens is we first of all need a superannuation member to meet a condition of release to be able to start accessing their superannuation. The member can then withdraw money from their super tax-free after the age of 60, and then we look to put that money back into superannuation as a non-concessional contribution, which is actually part of the tax-free component. So there's a lot to that probably already as a high level, but yeah, I'll start talking about how is superannuation made up behind the scenes, and how do we save for retirement. So you'll probably notice the PowerPoint is not in presentation mode, but that's because I actually wanted to draw diagrams and talk to you as if I was talking to a client for the first time who isn't aware of these different components of super. So that's why it's looking like this. So yeah, I'll just start drawing, and feel free to ask any questions as I'm drawing and explaining superannuation. But essentially with super, there is two different ways that we can put money into super. We have what's called a concessional contribution. So your concessional contributions are the pre-tax ones, and they are currently $27,500 for this financial year. And you may be aware contribution caps change all the time every year, but at the moment it's $27,500. And the concessional contribution is generally made up of your super guarantee. I can get my finger to work. Super guarantee, salary sacrifice, and personal deductible contributions. They are the broad contributions that go under that cap. And when that money goes into super, it is only taxed at 15% on the way in. So it is concessionally taxed compared to our personal income tax rates. If you're earning between $45,000 and $120,000, we're generally paying 34.5% tax on that income. So any money that goes into super under this concessional contribution limit is we're only paying 15% tax on the way in. So there's that big tax savings. Now those contributions, they actually go into the taxable component of your super account. And so these are your red marbles. Now the other type of contribution limit, broadly speaking, is your non-concessional contributions. And this one here, we can put in $110,000 per year. And if we're under the age of 67 and we've got less than 1.7 million in super now, we can do something called a bring forward rule, which means we can bring forward an extra couple of years and do up to 330,000 all in the one go. It just means that we can't do anything for the next 2 financial years after that. Now, these contributions, we don't pay any more tax on the way into super. And you can imagine with that sort of contribution cap, it's quite large, and you're probably thinking, where would I get 110,000 or 330,000 from? But a lot of people might sell a lumpy type asset like an investment property, for example, or they might receive an inheritance. And this is where the contribution cap can be quite useful. So when we're putting money in under that non-concessional contribution cap, we have to deal with the tax on that, sold investment property or the inheritance separately. So capital gains tax is outside of super. And so because we've assumed that we've dealt with the tax outside of super first, when this money goes into super, we don't pay any more tax on the way in. And these types of contributions are your green marbles. So they go into the tax-free component. Now, with your superannuation statements, unless it's a self-managed super fund in the member statements or financials, most industry funds and retail funds won't actually print on the member statements what is taxable and tax-free component. But as a financial planner, when we are doing our initial data collection and research, we will call the super fund and ask them about the taxable and tax-free component so that we can see, is there any opportunity here and how much benefit might be available. With the, so I guess with superannuation, we've got your concessional and non-concessional, and most people, when they come in to see me for the first time, their superannuation is pretty much always red marbles, like it's a whole bag of red marbles. That's pretty common. There might sometimes be some green marbles, but for most people it's very common to have a bag full of red because they've just been having their employer contributions go in, and they might have been doing some salary sacrifice or something like that. And it's usually, if they've got a lump sum money to put in, they'll usually come and get some advice first before they start throwing in hundreds of thousands of dollars. So we've spoken about how money goes into super. Now, talking about how money comes out of super. So there's a couple different options when it comes to drawing money out of super. So in the account I was talking about before with the taxable and tax-free component, that was an accumulation account. So that's where the money goes into. But we can also have roll our money over into a pension account when we reach our preservation age. So 59 or 60. It's going to be 60 for everyone soon. Now, that tax-free and taxable component does translate down into the pension account as well. So if we've got a bag full of red marbles up in the accumulation account, that's going to go down into the pension account as well. And in terms of drawing money out of super, when we're over the age of 60, we can either set up a pension account. And the idea with that pension account is that we're drawing out a minimum percentage each year. It's a legislated minimum, but we can choose to take more if we like. And if we are over the age of 60, then it is all tax-free withdrawals. If I can get that to work. So that's one option in terms of drawing money out of super. The other option is to draw a lump sum, and that is also going to be tax-free if we are over the age of 60. Now, in terms of what happens if we pass away and our money is going to different beneficiaries. So if I just go back up here, because it's a bit easier to see with the colours, if your superannuation goes to a tax dependent, then your superannuation is tax-free. So, for example, if your superannuation goes to your spouse, they're considered a tax dependent, it's tax-free. But if your super was to go to someone who is a non-tax dependent, and the main example here is someone like an adult child, then the way it works is that they would receive the tax-free component tax-free, as the name suggests. But on the taxable component, they pay 17% tax on that those red marbles. So it's 15% tax plus 2% Medicare. That's how they get to that 17% tax. And the way to think about it is that if you had non-concessional money or tax-free component, the green marbles, you've already paid your full tax rate on, your inheritance or your investment property or just your regular savings. So that's why the kids aren't going to pay any more tax. But if you've had concessional contributions, which is your taxable component, your red marbles, so if you've got a bag full of red marbles there, you've only paid 15% tax on the way in, where most people are paying over 30% on their income. So the government just tries to recoup some of that money with the ultimate beneficiaries, being the children, by deducting another 17% tax there. So we've got tax on the way in, and then tax on the way out, and then tax to the member as well. So there's a few different taxes to be aware of, and that's why I was saying earlier it can be quite confusing with the different tax-free and all that. That's why I just try to say red marbles and green marbles to my clients. So there's no questions so far, which is good. So I thought after explaining those diagrams, start going through a bit of the detail about why do we even care about those different red and green marbles. So with superannuation, most people are probably aware already that superannuation isn't covered off under somebody's will automatically. And the superannuation law says that the super fund can only be paid to certain people. So it can go to a spouse, it can go to children of any age, it can go to financial dependents and people that are in a dependent relationship with the beneficiary, with the member. And you can also choose for your super to your legal personal representative or your estate and get paid out as per your will. So it can get pushed out to the will if you do have other beneficiaries that you want your super to go to if they don't meet one of the other criteria. But the main point I was trying to get at earlier on is that whilst we can pay to any of those super dependents, the spouse, children, financial and interdependent relations, they may not be tax dependent, so they might have to pay tax on the inheritance. And the main one here is the children who are over 18. They can receive a super death benefit, but they might have to pay some tax on it. And the same goes if the super was to get paid out to the will and get paid to a non-dependent beneficiary, such as a sibling or your parents or nieces or nephews. They may have to pay tax on it if it's all in those red marbles there. Now, in terms of how the strategy works, I'm just going to just create another slide so I can talk that through. Basically, we have an account full of red marbles, as I've mentioned. Now, when somebody gets access to their super and start drawing down on it, they may choose to take out a lump sum from their super or take out a large pension payment. And that money gets drawn out tax-free if the person's over 60, as I mentioned. And so that would just go into their bank account. And the thing to note as well with super is you can't tell your super fund, I only want to draw my red marbles out. They will draw it out proportionately based on the components behind the scenes. So if you have an account with 90% red marbles and 10% green marbles, when you draw your payment, 10% will come from the green, 90% from the red. So, we can pull money out of super once we're over 60 and we meet a condition of release. And then essentially we can choose to put the money back into super as a non-concessional contribution under those limits that I mentioned before, and then they go in as green. So the idea is we're pulling out red marbles and putting it back in as green. And depending on the superannuation structure will depend on whether you choose to put that back into the same super fund or whether you have those contributions being directed into a whole new account, which would be 100% tax-free, or if it's a self-managed super fund, there's different potential rules there. So this is where it can become quite complex depending on the member's balance, and having multiple super funds can sometimes be quite beneficial from an estate planning perspective as well, especially if the member has goals around wanting to leave money to children versus their spouse. And, you know, that can also be beneficial from like even an age pension perspective later on. And blended families is another, you know, a real reason why some people might want to have multiple super funds, because then they could choose to have their adult children inheriting this tax-free component, so the kids won't pay any tax on that. And then they might choose to have their spouse inherit that account there, which has the red marbles. So just moving ahead, as I mentioned, there's different ways that we can pull money out of superannuation, and the same goes for somebody who's inheriting super monies. So depending on who is going to inherit the death benefits, they may be able to take a lump sum, they might be able to take a pension income stream, or a combination of both. And it will depend on who is inheriting the money and what does the trust deed say. And then there's different tax consequences depending on how old the member was of the super fund before they passed and who is the beneficiary receiving it. So this is getting a bit more complex now, but just trying to highlight that it is this whole area of advice. And today, like I mentioned, I was trying to keep it really simple and just explain there's lots to it, but there's lots to consider.
Deline, we've had a few questions come through around the consequences of paying the super to the legal personal representative so it forms part of the estate, and the tax consequences of that. So can you sort of explain how that is taxed? Because I think once we get our head around that from a legal perspective, like the lawyers are getting their head around that, I think that will really highlight the power of the recontribution strategy.
Yeah, sorry, I had the private chat going, not the comments, so I couldn't see them coming through.
One of the questions is, if an adult child receives super, but it's like the binding nomination or the payment from the super fund has paid it into the hands of the legal personal representative, and then the will gives the super to an adult child, what's the tax?
It comes down to who the ultimate beneficiary is. So even if it's going through the estate and going through the legal personal representative first, it comes down to who is ultimately receiving the benefits. So even if it's a look through. Yeah, that's right.
Yeah.
But that's why if we can do these strategies by recycling the red to the green marbles and trying to make that as tax effective, it does just make things a lot cleaner and easier when the super fund's paying out the benefits, and then the estate having to deal with the tax as well. Yeah.
So I think from a lawyer's perspective, we just kind of think, everything that comes into the estate can then be gifted tax-free, because there are some very generous capital gains tax exemptions on assets transferring under a will, but super is not part of that. So if they're not a tax dependent, then the estate will be liable to pay tax on that before it passes through. So this is why it's important. You can't just go, oh, well, it's a binding norm to the estate, disregard all the tax. It will be taxed before it ends up in the hands of the adult children. And so this strategy is such a value add for making an inheritance go so much further, because we're going to save that extra 15% tax. Deline, there was another question about the 2% Medicare levy. Does that apply if it comes into the estate, or is that just for nominations directly to a beneficiary?
I actually can't remember, sorry. I would need to look that up. Yeah, it's not something at the top of my mind. Sorry.
I actually don't know the answer off the top of my head either, so we can look that up.
Yeah, I have looked it up in the past. I just can't remember it right now, to be honest.
Yeah. And I will just say, this is, if you are a lawyer looking at this and you're not across the superannuation proceeds trust strategy about how the testamentary trusts overlay with that, there is a separate training on that as well. And it's worth getting up to speed on, because for, a lot of our clients, their super benefits are a huge part of their wealth that they're transferring on. So having a working knowledge of the tax position as a basic sort of starting point, and then some of the strategies that we can do to optimize the outcome and maximize the benefit that passes to the beneficiaries is really important. So we can't just kind of put our head in the sand and go, oh, tax super, ooh, I don't really want to deal with that. We can add so much value here by knowing when to escalate this to get advice.
Yeah.
That's my little 2 cents. I'll let you get back to your presentation, Deline.
No, that's okay. That's it's really good that you've mentioned that, because I do see that financial planners and lawyers can work really well together to firstly work out what is the flow of money, and then where should it end up, and then what's the tax position going to be, and is there any benefits or strategies that the financial planner can recommend to reduce some of the tax. So I do see it working hand in hand. So excellent point to make there. Because we might just have a couple, a husband and wife, for example, and they just want their superannuation to go to each other, or in their will, everything is just going to each other. But we need to kind of think past that point. What happens if both members or both people of that couple pass away at the same time? What happens to the money then? Or if one person in the relationship passes and then there's just a single person that's got all the money, what happens then? And I guess it's really important to, in my opinion, to look at these strategies as soon as we can, because we can't predict when we might pass away. If we could, we can just plan everything perfectly, but we can't ever predict if we will literally spend all of the money in our super and we will, not have anything left to give to the kids later, or if we're going to pass away tomorrow. So that's why I think it is like a great strategy to look at. And just as a side note, if we did know when we were going to pass away, so if I knew I was going to die in a week's time, then, I might just want to withdraw all my superannuation and that way, and put it as cash in the bank. And that way, if my kids were to inherit the money, if they were adult children, for example, then they would get that all tax-free. Because I've drawn it out sitting in cash. It's not a growth asset. They can receive that cash tax-free. But the reality is we can't predict a lot of the time when that might happen.
Although I will just say there is the deathbed planning strategy.
Yes.
So if you have got someone who's over 60, or are there other conditions of release they can satisfy, Deline, or is it they have to be over 60?
Yeah, no. So the most common conditions of release here, so usually when somebody's alive and healthy, we've got 65 is a significant age for superannuation. because that's when we can access our super regardless of whether we're working or not. So that's the first age that is quite significant. The second significant point is if you've reached your preservation age, which is going to be 60 for everybody soon. I think it's 59 at the moment, but has been as low as 55. If we've reached our preservation age and we are retired, and retired means we're not working more than 10 hours a week in the future, then we can start accessing our superannuation. Then we've got this other tricky retirement condition where if we are between the ages of 60 and under 65, if we cease an employment contract, our money that was already in the super fund becomes unrestricted and non-preserved. And then even if we decide to go work somewhere else, then we can still access the money that was already in the account. It's just the new money that starts coming in when we've started the new employment contract becomes preserved until we leave that job or we get to 65. So yeah, between 60 and 65, there can be some unique conditions there. Then there's things like permanent incapacity. So if you meet the condition there, then you can start accessing your super regardless of your age. And then there's some other conditions as well, which are less common in this strategy, like financial hardship or compassionate grounds and things like that. The thing to note with withdrawals from super, though, if you're under the age of 60, there might be tax associated with it. So, yeah, you might be on your deathbed under the age of 60 and then want to withdraw your super because you meet a condition of release, but you've just got to be aware there may be some tax on it.
Okay.
Yeah, so it's a bit of a tricky one. And the transition, there's also a transition to retirement strategy, which is when we are of our preservation age, so between 60 and 65, and we don't meet a full condition, we can't withdraw all of our super, but because we're still working, but we can set up our super to draw down a maximum of 10% a year. That's really highly simple the way I'm explaining it. But yeah, we can draw up to 10% a year as an income payment. So for somebody who has a really high account balance, that 10%, like if they've got $1 million, for example, that could be their non-concessional contribution cap anyway of 110,000. So that still might be an opportunity we look at in this type of strategy. Just sort of have a look at these comments.
Yeah, while you're looking at the comments, I mean, yeah, obviously there's a lot of moving parts. So sort of speaking from the lawyer's perspective, I think the first thing is we just need to identify, well, maybe we're in the realm of a financial advisor being able to do something here, and then we just sort of move it into the financial advisor space. All we're really doing is trying to identify an issue. I suppose just to round out the deathbed withdrawal would, that also gets very complicated because sometimes we're looking at interlaying, well, have we got an enduring power of attorney if our person has lost capacity to then act on behalf of the member to make the withdrawal? So it can get pretty complicated pretty quickly, but it is something to sort of always have on your radar as to, like, is this going to end up making a big impact on the beneficiaries and the estate? And then I would just, if I was in that position advising on it, I would just bring in my professional team as early as possible so that we can sort of look it through and work through all the various rules, because there's a lot of rules to overlay, and then see if it is something worthwhile pursuing.
Definitely. I do think it's a team approach with the professionals. I have had some clients who they've got like a self-managed super fund, and they do have the withdrawal notification so that if they are on their deathbed, they can just quickly liquidate everything and withdraw all their super. The risk with that strategy, though, is if you withdraw all your super and then you don't actually pass away, you might not be able to put that money back in, depending on your age and working status. So you just got to be careful with that. And then, there were some different comments in the in the chat box there around, it does depend on if you're terminally ill or TPD. Like the tax is always going to be different depending on the criteria we're trying to claim our super if we're under the age of 60. It's not, I guess I'm just trying to just highlight there are different considerations, but maybe best to get advice on the individual circumstance at that time. The first step is we're looking at what condition of release can we draw money from, and then the next step is then looking at our withdrawal options. So this strategy is really ideal for people who are over the age of 60, so they're turning 60 in the financial year or older. And that's because when we draw money out of our super after 60, it's always tax-free. I shouldn't say always, because there's always something, little nuances with like untaxed funds and things like that. But for majority people, it's tax-free. Ideal for people over 60, we can withdraw money tax-free from our super. And then I've just made a note there as well that you might be able to draw funds out before 60, but there could be some tax on the withdrawals, which might reduce the benefit of that recontribution strategy. And then in terms of how we draw money out, it could be done as a lump sum withdrawal, or we could set up our super as a pension and start drawing pension payments out. And generally pension payments you could take as a yearly amount, or it could be, yearly, fortnightly, monthly, like it depends. And then I also made the comment about the transition to retirement strategy before, where we can set up our super and draw up to 10% as well. And then, so we've basically looked at what's our option on withdrawing money from our super. Then we've actually drawn out money from our super and drawing out those red marbles, as I mentioned. And then we've got to look at how we put that money back into super. So for a lot of people, this type of strategy has to be done over a number of years because of the contribution caps in place. So if somebody had $1 million in super, we couldn't just pull out $1 million and then put it all back in because of the contribution caps in place. Now, currently the non-concessional contribution cap, so that's those green contributions, it's $110,000 a year or $330,000 over a 3-year period, but it does depend on your account balance. So if you did have more than 1.7 million in super, then you can't make any more green contributions into your super. But if you've got less than 1.48, then you can still do that full 330,000. And then there's all different criteria in between as well. Also in regards to contributions, so we can make contributions into our super up until the age of 67 and not have to meet a work test. But after the age of 67, we need to meet a work test. And what that means is we need to have worked at least 40 hours in a 30 consecutive day in the financial year. So just one 30-day period in the year, we just have to work 40 hours. So you might go dress up as Santa at Christmas time, for example, and meet that criteria. But after 67, there's no bring forward contribution limit available. But I just want to also point out that this is like what's currently legislated. It was only a few months ago that you could do the bring forward rule up to the age of 65 only. So it was only a few months ago that it was legislated that they changed it to 67. And they are proposing to extend the age from 67 to 74 next year from the 1st of July 2022. But today I'm just talking about what is the current legislation. So main points there is we've got different contribution caps. We need to consider what is our total super balance before we start making contributions, and what is our age and work status before we put money in.
Deline, can I ask a question about the bring forward with the 330? So does that count? I don't know if I'm going to explain this right. Does that count backwards? Like if it's coming up to 30 June for 2022 for me, say I meet all the other tests and I haven't made a non-concessional contribution in the 3 years prior to that, can I use my 3 years to count to 2020 and 2019 and do 330,000 on 30 June, and then on 1 July can I then go forward another 3 years and do another 330,000?
Yeah, so you can't carry forward contributions for non-concessional for those green contributions. You can only bring forward. So you can't use past limits and carry them forward. You can only bring future contributions into this current year.
So is the best I could do 440,000?
Yeah. So
over that financial year?
Yeah, that's right. So I do, depending on when we are in the financial year. So if we are in the second half of the financial year, for example, from January to June, by the time you write the advice and actually implement it, sometimes I might just suggest to somebody, let's just do 110,000 now. And then after the 1st of July, which is a new financial year, trigger the bring forward then and do 330. And these caps are per person as well.
Yeah.
And as I mentioned, I am keeping it quite simple. So I haven't even spoken about other types of contributions like downsizer contributions as well, which are basically for people who are over 65 that sell their home. There's a whole heap of other criteria around that as well, but they can put in 300,000 per person if they sell their home too. So there is potential to do a lot more than just the 110 or the 330. It always just depends on the personal circumstances.
Thank you for explaining that. So there's a fair bit of discussion going on about the work test, but I think you've answered that as we've gone through. And thank you to Chris Harold for confirming that the Medicare levy doesn't apply on the super tax in the estate. So that's only if it's a direct nomination to a death benefit dependent.
Yeah, and that does ring a bell now, because I think that's part of the process where you've got to think about, it might be a bit less tax if it was to go to the estate versus the dependent directly. So definitely something to consider. My final slide was just a bit of a summary for the lawyers out there that at the moment this strategy is ideal for somebody between the ages of 60 to 67. And if they are over 67 right now, they're working, whether it's casual, part-time or full-time, there still might be opportunities there. And it's ideal for somebody who does want to reduce tax to their beneficiaries outside of their spouse, just to, again, keep it very simple. And it is an ever-evolving area. It was only a few years ago where the contribution caps were 180,000 per person or 540,000 as a bring forward. But then they got reduced and have slowly been indexed again and increased slightly. But it is an ever-evolving area. And, part of the reason of changing those contribution caps was to stop people doing these strategies, because it does result in less tax to, the government. But if they do extend the contribution limit without meeting the work test next year, that will open up a whole heap of more opportunities for people up until the age of 74. So we just got to cross our fingers and hope that goes through.
Thank you so much, Deline. I really think you have done such a tremendous job at making a very complex topic simple. Everyone is raving about the green and red marbles, so I think we'll have a few people copying that. So thank you for sharing that with us.
That's okay.
Are you happy to take any more questions now? Or was there anything else you wanted to mention for your substantive presentation?
No, that was just a summary of how the strategy works, and I did try to simplify it. I don't know if I did, but I wish I could take credit for those red and green marbles, but I was actually mentored for years by an excellent advisor, and she actually taught me that analogy. So I know some advisors say it's like the dirty money and the clean money, but I think the red and green is a bit nicer than talking about dirty and clean money. So yeah, I'm glad that
now you have passed it on as well as part of your mentoring. You've paid it forward. Can I ask a question while we're waiting to see if any more questions do come through? Now, with adult children and what age does the tax kick in? So I think you had in your slides it was 18. I have heard that if they are financially dependent, then it's tax-free up until they're 25. Is that right? And if so, can you elaborate a bit more on it?
Yeah. So, it does get a bit tricky because an adult child still might be able to receive the superannuation benefits tax-free if they're considered a financial dependent or in an interdependent relationship. So an interdependent relationship is somebody that has, quite a close relation. You probably can describe it better in legal terms, but somebody who's got a really close relationship with the member of the super fund above what is normal in terms of like a friend or family member. There could be some financial dependency there as well. So there can be it can still be tax-free after 18, but I guess just to minimise the risk of that condition not being met, then it is good if we can just eliminate those red marbles. And then in regards to the age 25, that is more in regards to if the superannuation was to be set up as a death benefit pension. Rather than taking the money as a lump sum. So that's why I was trying to keep it high level and say, it depends on how the money is going to be received, if it's a lump sum versus pension. And it depends on the deceased person's age and then the beneficiary's age and dependency condition.
Okay. We actually have got a Facebook Live very recently on pensions, child pensions. So people can go and look at that if you want, rather than you having to sort of just quickly pull together a presentation on that.
Somebody else mentioned their balance. Yeah.
So this is from Narelle. Thank you. Really good question, actually. Now that you've said it, I have this question too. So is there any different treatment of the actual super balance on a person's death versus the payout of the death benefit from insurance, which is attached to the super?
Yeah. So, good question. So it comes down to, who's receiving the benefits from the super fund. So the insurance gets added to the account balance and then gets paid out. But what we need to be aware of with the insurance payout to the super balance is it going to the red or the green marble section? So that's where if it's life insurance, for example, and it goes into the red marbles, but if it's going to a spouse anyway, it doesn't matter the tax. But then if it's going to adult children, well, that's when it starts. It does matter. And then if it was a TPD payout, then it's generally the red marbles, but then there's a green marble component to it as well, which is added or takes away from the red marbles because we're looking at if the person had continued to work normally to their future retirement age, they kind of change the components behind the scenes. So I'm trying to make that as simple as possible. But hopefully that makes sense. Yeah.
Well, so can I clarify then? So insurance proceeds paid on death, so life insurance, if the deceased was the owner of the policy, then and the life insured, then it would be received into their estate tax-free. But if it's owned by the super fund, then those insurance proceeds go into the red category, red marbles, and so there is some tax on that.
If it goes to like adult children, for example, that aren't.
Yeah,
But if it's going to a spouse anyway, yeah.
Okay, so red marbles can be tax-free if they're paid to a death benefit dependents for tax purposes.
Yes.
But if they're paid to someone who doesn't satisfy that, then there will be like the 15 or 17.5% tax on it.
Correct.
Yeah, okay. Got it. So really, you know, the more that you can turn your red marbles into green marbles of the superannuation like balance, then the better that the client is setting themselves up for to minimize the tax payable from the super and insurance.
Yeah.
Okay.
That's correct. Yeah.
Wow, this is okay. I mean, I think if anything, like this presentation has just highlighted how many moving rules, and like each rule has got like all these different categories. So it seems just like an incredibly complex area. But I think we've got some really good parameters that as lawyers that we can sort of work to, you know, in terms of just if they're between age 60 and 67, if they've got a fair bit of their estate is in super, then that's where it's probably worth getting them to talk to their financial advisor. Or like, is this something, if a client doesn't have a financial advisor, is it something that as an advisor you can look at and pretty quickly go, yeah, this is worth pursuing or not? Because we don't want to waste your time with all these like referrals that don't lead anywhere because the solution isn't available.
Yeah, no, you can easily identify pretty quickly whether there's going to be some value there. In terms of like if somebody doesn't have a financial advisor, they may be able to speak to their super fund who might have advisors that give like intra-fund advice or give general advice. But I don't believe this type of strategy would fit the criteria of intra-fund advice. So they might be able to talk generally about how it works, but they wouldn't be able to advise on it. So that's where you do need to find somebody who can give comprehensive financial advice. And, you know, sometimes when I'm having an initial meeting with somebody, they might be a single person, and I'll explain to them how superannuation works as a whole, just like I did earlier on in the presentation. And when I start talking about the red and green marble, sometimes they just don't care. They say, well, like anything that is left to their kids or, you know, nieces and nephews or siblings, whoever it goes to, like it's a bonus. So they don't mind that there is tax that goes to those beneficiaries. But then there are other people that are really, that think, well, if it doesn't cost too much to implement the advice, why not, if it's just a bit of a restructure?
Yeah. Okay, well, I don't think we've got any more questions. We've had a lot of people asking questions on the way through, and I'm loving all the conversation going on in the chat. So, Deline, I guess you'll be able to catch up on that once we wrap it up. On behalf of everybody, I just want to echo the comments saying that you have explained this so simply, and thank you so much for making time to share your knowledge with us. This has been tremendously helpful, and I love the diagrams. I think everyone is loving them. So what we might do is wrap it up. I just want to mention one thing to the lawyers. So if you use my Testamentary Trust Precedent packs, I will be making a round of updates in the next month or so, depending on how everything works out. And one of the updates will just be adding into the meeting agenda templates these parameters that Deline has given us so that we can actually help identify, you know, we've put it into our process that we can identify when to make a referral on this issue. So watch this space. What I might do is wrap it up then. If you're watching this after the event, then please feel free to add in your comments or questions. Deline and I will keep an eye on it, and we'll try to answer those as well, even if you couldn't make it real time. And then the last thing before we go is that I just want to acknowledge that today I'm hosting the training from the lands of the Ugamba people, and I want to acknowledge the traditional custodians of the lands on which each of you are living, learning, and working from today. Thank you so much for joining us. We'll see you next month. Bye.
Bye.